Thank you, and thank you everyone for inviting us here today. Before we get started talking about AllianceBernstein's approach to integrating climate change into our investing process, I'd just like to take a moment to applaud our policymakers and regulators for bringing us all together today. This is the type of collaboration that we need across industries and sectors between public and private, and we really encourage this type of dialogue. I think what we're really talking about today when we're talking about climate scenario analysis is something that Charles alluded to earlier, which is finding the right balance between quantitative information and qualitative inputs that we need in order to interpret that information. Of course, we all want data. We want good quality data, but we have to also recognize that data does not alleviate all risks and it does not enhance all outcomes. And so in our view, scenario analysis will be one piece of the puzzle that we incorporate into our decision making when it comes to trying to identify, research, and engage on material climate-related issues in the investment process. Before we dive into our climate scenario analysis work, I think it would be useful to set the table in terms of how AB approaches ESG as a firm. We take a three-pillar approach, so number one being a responsible corporate citizen, incorporating ESG considerations into how we operate. The second piece is really focused on ESG integration, and that's really where we're going to spend our time today. We believe that incorporating E, S, and G issues that are material to investments actually makes for better investment decisions. And then finally, we have our suite of portfolios with purpose, which are ESG-themed products and services that also serve financial returns. At AB, our responsible investing and our ESG integration is investor-led. So we on the responsibility investment team, we really seek to partner with our investors across asset classes, across sectors, and across regions. We provide them with tools and infrastructure and resources, but we really feel that as analysts and portfolio managers that sometimes have decades of experience covering companies and sectors and asset classes, they're really best positioned to make decisions on where to allocate capital. Our commitment to climate really starts with our fundamental belief that climate change poses material risks and opportunities to investments that we manage on behalf of our clients. And this is really represented through four different pillars in terms of our understanding that climate change risks and opportunities are currently mispriced in today's markets. And by providing our investors with education and training on this issue, we give them an investment edge. And finally, we also take into account our own environmental footprint as an organization. The way we action these beliefs is through our strategy, particularly partnerships. So as we're all sitting here today from different organizations, from different spheres, there's no one organization or firm that's going to solve for climate change alone. We really need to engender more collaboration and more partnership in order to solve for this systemic challenge. And I'm going to focus on that partnership a little bit more today because, as the Vice Chair noted, we need a scientific basis for understanding these risks and opportunities and integrating them into our investment process. And our relationship with the Columbia Climate School has really provided our investment teams with that basic understanding. The relationship with the Columbia Climate School is really focused on bringing together investors and climate scientists and faculty in order to better understand not only the climate science, but also for those scientists and faculty to understand the needs of private sector players who can make a real impact in terms of addressing these risks on behalf of our clients. One of the projects that we've embarked on with the Columbia Climate School faculty is on looking at and reviewing scenario analysis products across the market. The Columbia Climate School faculty were part of a large working group that we put together in 2020, 2021, to specifically an RFP process looking at the different scenario analysis providers on the market at that time. And I would just stop here to say that this is not just a quantitative exercise again, but given the depth and breadth of resources that we're dedicating to this issue, it's really been a transformational initiative at our firm in terms of how we integrate something like this into our investment process, whether that's on the investment teams themselves or their supporting teams when we think about legal and compliance, data science, executives, etc. So let's dig into scenario analysis itself. But before we do that, I think we need to acknowledge that climate is incredibly complex and multifaceted, and we as investors generally only see one very small part of the picture. Climate change has long lead times, lots of variability, and there's lots of factors in climate change that impact each other and lead to cascading events. And climate scientists are only starting to begin to be able to predict what some of those outcomes will be. In addition to that, we have the human and social and policy response to climate change. And I think as we can all see and experience ourselves, that's also often very difficult to predict in terms of consumer behavior, political considerations, and economic interests. But we can't let perfect be the enemy of the good. And we have to start somewhere when we're thinking about climate change risks, both at the macro level and at the issuer level. I realize that my colleagues who come before me have already drilled down into what physical and transition risk is, so I'll devote this slide to talking about some of the macro effects that we anticipate. So as climate change becomes more severe, we would anticipate that inflation will be higher, and we anticipate that as in spending will go more, or capital allocation will go more towards activities to mitigate or adapt to climate versus more productive spending. And indeed, some capital may be lost to stranded assets. In addition to that, when we think about productivity, we think about labor, we think about agricultural inputs. So as the world becomes warmer and wetter in certain areas, we would anticipate that productivity will go down. And what we show you here in this slide is under those various socioeconomic pathways that the doctor walked us through earlier. In every case, no matter what the temperature increase is or minimum temperature increase is, there is an impact on GDP growth, and it generally leads to a decline. In some cases, this might not seem very significant, but if you think about pre-pandemic growth running 2.5% to 3.5% globally, even a decline of 1% is pretty significant. So we also use the climate value at risk model at AllianceBernstein, and I'm delighted to be coming after someone like as esteemed as Charles in terms of walking you through this, because I think what we're presenting you here today is the variety of interpretation and the variety of results you can get from using the same platform. So again, this platform looks at transition risks, and it really does that by using carbon pricing. It looks at technology opportunities from patents and green revenues. And then, of course, it looks at a number of physical risks, both at an issuer and then aggregated up into a portfolio or a fund level basis. Within the CVAR platform, you can choose from about 15 different scenarios. I would just note that when we first contracted with the CVAR platform, the network for greening the financial system scenarios actually didn't exist yet. And that's important because one of the things that we need to understand is that as science improves, as data improves, as our understanding of climatic systems improve, these scenarios are going to evolve over time. So the results that you're seeing here today will likely look very different over the next few years as these types of products and these types of analyses mature. We use the NGFS scenarios because we believe that these scenarios are emerging as common and best practice, and that's really a reflection of NGFS as an organization itself. It's comprised of about 125 members, so central banks around the world, who are putting together these parameters in terms of social and economic expectations. And one of the things that I would like to point out is there are a lot of rigorous expectations here. So if we look at the 1.5 degree scenario, what we see, just to point out the carbon price, given the doctor's remarks on carbon pricing today, the carbon price would have to increase substantially to almost $700 in order to achieve a 1.5 degree scenario, according to this central banking group. So let's walk through some of the results that we've put together just as a test run to walk through our findings. So what we have here is a 1.5 degree scenario, a 2 degree scenario, disorderly, and then a 3 degree scenario, which is almost kind of status quo if all countries meet their nationally determined contributions. And we've run 3 benchmarks through each scenario. So Euro Stoxx 50, this is a composite of leading European companies across sectors. We have MSCI World, and then we have the MSCI ACWI Commodity Producers Index in purple. And so what stands out to us about this particular analysis, if you're just looking at it purely from the top down, is that the biggest risk or the biggest hit to CVAR doesn't occur in a 3 degree scenario. It actually occurs in a 2 degree disorderly scenario. And the reason for that is that this scenario makes an assumption that there will be a very abrupt effort to try to resolve climate change issues by policymakers by drastically increasing carbon pricing and policy, and companies won't be prepared for that. So this will more negatively impact them than, say, in a 1.5 degree scenario where policymakers are slowly inputting these types of policies to control for carbon versus this 2 degree scenario. In a 3 degree scenario, you're seeing very little impact or less impact, mostly because policymakers are not stepping in and stepping up those carbon prices. And now we're going to spend a couple of slides just digging more underneath, or really opening up the hood when we talk about the different types of risks and opportunities across these benchmarks and across these scenarios. So as you can see here, what's really driving most of the risks that we're seeing at the top-down level is actually that policy risk, that transition risk. So this is that carbon pricing mechanism within these portfolios. And again, the 2 degree scenario is really where you see the most abrupt and most severe impact. The other thing to point out here is that physical risk is pretty static across each of the benchmarks and each of the different degree scenarios. And this is kind of consistent with our findings when we reviewed all the scenario analysis providers, and that some providers are much stronger in assessing transition risk, some are much stronger in physical risk. But what this indicates to us is that there's not really a great connection between the policy and the physical risk parameters. And so in a 3 degree world, you would assume that there would be much more physical risk present, but that's not really accounted for in this model. And then finally, technology opportunity. This makes sense. The one thing we would point here is under a 3 degree scenario, there isn't really as much of a positive impact on that CVAR number because companies are not being compensated as much for the moves that they're making to green their businesses. And now we're going to break down each of those factors. So policy risk and technology opportunity, and then we're also going to explore some of that physical risk. So 2 things to take away from this slide. Number 1 is that the policy risk contributors are all energy companies, and that's what's expected. However, what's really driving that policy risk is not the use of sold products like oil and gas. It's actually the Scope 1 emissions that these companies generate just from operating their wells and hard or heavy assets. In our view, we really spend a lot of time engaging with companies on Scope 3 emissions. Oil and gas companies in particular, Scope 3 emissions generally make up about 99.5% or more of oil and gas companies' emissions footprints. So to us, this kind of result is flagged. In addition to that, we see the technology opportunity contributors. And there's what we would like to point out here is that what we generally find is there's a lot of overlap between companies that are contributing the most risk to portfolios when it comes to climate, as well as the same companies contributing the most opportunity. And so the point here being is that that's not something you're going to see at first pass when you look at this type of analysis. That's something that you have to explore and dig deeper on in order to realize that in order to enable the transition that we need, in order to address some of the more severe risks that we'll see from climate change, we really need to engage these heavier emitting companies to ensure that they're transitioning their businesses and transforming them to be successful. So in terms of the physical risk, I think what stands out to us is that most of the physical risk here, according to this analysis, is being generated from coastal flooding. And so at first blush, you might think that this is because these companies have lots of operating assets that are in low-lying coastal areas. But even as Charles pointed out, or as the doctor pointed out, when it comes to disclosure around companies' assets, that's very, very limited. And so what this is actually showing us is company exposure in terms of office space. And I think one of the things that we can all acknowledge after the pandemic is that companies tend to keep functioning even if they're not in the office. This isn't really giving us the data, the window or the view that we need to understand the bulk of the company's physical exposure in terms of those operating assets. And that brings us to, I think, the final piece here, which is that we would note that the models and scenario analysis that need data, that use data as this input, they're only as good as the data that's being input. And that means that garbage in terms of poor data doesn't make the data better when it goes through these models. In fact, it can distort the results quite substantially. And you really need to have a fundamental analysis and review in order to understand what these results are telling you versus a pure top-down approach. And that's really where active managers can come in and I think lend a really insightful and nuanced view to how companies are actually identifying and addressing and meaningfully integrating climate risks and opportunities into their business. So when we think about how we're integrating this piece of our ESG approach, it's really focused on the cornerstone of engagement and really focusing on the piece on the left, which is engaging for action. So not just engaging for information, but engaging to ensure that companies are positioning themselves to be successful and viable concerns in the future. And that process to us has led us to develop a structure where we target companies or we identify companies that have this high risk to their business, we assess them, and we engage and monitor them over time. The high impact companies that we've identified that are really driving emissions in our portfolios are outlined here. Once we identify companies in these industries, we go through another step to figure out which companies are driving the financed emissions in our portfolios, and that generally leads to only a handful of companies that we need to analyze at a time. And then we run them through this framework to not only understand where companies are in terms of how they're addressing this risk, but where we need to engage with them over the long term to ensure that they are positioning themselves to be thriving in a low-carbon economy. These are the types of questions that we ask, that both in engagement and in research. And again, this is really aimed at helping us identify where we need to work with companies over time, and how we can measure their progress going forward. And this includes some questions that we have on climate solutions. So recognizing that this is not just a risk framework, but there's also opportunities that we need to capture as we think about climate change and solutions. While there's a couple of different examples here, I realize we're just running out of time. And I'd like to leave this group with a couple of thoughts. So number one, to circle back to our initial point, collaboration among policymakers, investors, companies, academics are going to be really important to helping to solve this challenge, particularly in terms of improving the transparency that we need in financial markets to ensure that these risks and opportunities are priced in. And that greater consistency is going to be absolutely crucial across regimes. And hopefully that will help us improve the data inputs that are going into these models and improve those results in order to make them decision useful. And again, data is critical. It's important for understanding how companies and how issuers are managing material risks and opportunities, but it must be complemented by fundamental financial analysis, and we believe that active managers are really well positioned to do this. Thank you.